Welcome back. We are recording this morning. It's Thursday before market open. A segment we're going to continue to probably do as we update, try to make a little bit of sense out of these tariffs if there is any sense to be made. We'll talk about what's happening, what's some of the good news, what is a lot of it is bad news. The market, we haven't seen a single trade since the market's been open, looking like it's going to be somewhere between 3 and 4% down at the open. So a lot can change once the market actually does open. But let's just start with the tariffs, Aaron. So I'm going to pull up a slide. Yesterday afternoon, we got updated tariffs. And when we look at it here, they're just too high. The market is going to struggle with this initial announcement of reciprocal tariffs because they're much higher. And the way they calculated them isn't actually the reciprocal tariff rate.
Yeah, no, there's a lot there. You said making sense out of it. And I would say that all models are wrong. Some models are useful. And watching and not trying to understand what was going on after yesterday's press conference, I've updated my model. And it's one that I've always been working on, is that Trump is a political entrepreneur. You go back to Nixon, whenever he was looking at how to bring the South into the Republican Party, I think Trump had figured out that the trade unions were a coalition that he could get to vote for Republican. But he had to go with tariffs and favoring manufacturing. And looking at this, I think that's what he's doing. Now, there is another coalition that tend to be a really hard, it makes an odd bedfellow, which is the free market type Republicans. So Trump's going to have to make those guys happy as well. I see that as tariffs. And then the next phase is going to be trying to cut taxes. And maybe that's why Doge is there, is because spending needs to come out on government. So I'm operating out of that model of a political entrepreneur who's trying to put together a coalition of people that really have very opposing views and try to win elections with this. And he may actually be very successful at this. That doesn't mean that it's not having an effect on the market. And we're definitely seeing that in the futures.
Well, let's start there because that's phase one. You referenced it, and we've said it since the beginning. It's really one of the only bad policies is tariffs of what they want to do. And we're starting with them instead of starting with what looked like you could have a win, which is start with some deregulation, start with the tax cuts, and work in tariffs over time. And when you looked at the original model that I was using, which was, if you look at what Betnick and Letnick were going off of last year, they both believed in that. They believed in don't tariff stuff you don't make and slowly build up to the tariffs, because that's the way you're actually going to get more manufacturing jobs, not just hitting them with the blunt force 40% tariffs on, Vietnam like we got yesterday. And that brings us to the next part, which is the uncertainty we have now. The market can price in new events. We get tariffs yesterday. We can look at that and say, what are the impacts going to be to earnings based on these tariffs? That's the good news. We've gotten past the point of when you have no idea what the tariff rates were going to be, you can't price that in because you don't know. You're just guessing. So the good news is probably we hit the high water mark for where tariffs will be. They could go higher. The question here now is, can they go lower? We said reciprocal tariffs, we will cut your tariff rate if you cut ours. The problem is the reciprocal tariffs look to be calculated based on our imports over total trade, which is not truly a reciprocal tariff. So what happens when they do cut their tariffs down significantly and the trade deficit over total trade? That's not going to change much. Maybe it will change, but if that's not something that's going to change immediately, what happens? That's the new uncertainty the market has to deal with, is that we'll get it in the next 10 days because we'll see some of these countries that do want to cut tariffs. So that's the new uncertainty that we're looking at.
If you are not subscribing and you enjoy cynicism, please subscribe now, because there's plenty of it. And that my cynicism is that you never get the good things that a politician is asking. You always get the bad things, and that's proving out true. And I would, when I first was listening to the press release and its reciprocity, I'm like, okay, we're gonna be down a little bit, and we're gonna move forward. This is the art of the deal. But then whenever I was looking at how that is likely to be derived, it's very much a blunt instrument. And it doesn't matter whether countries are having a tariff on the U.S. or not. It's just looking at what's the trade deficit, and then how do you take half of that and put an import tax on there. Now, I do think that will cause manufacturing to be favored, or it'll put at the margins, there will be decisions that move things to the U.S. From that. But there could also be different things where people just ship stuff from one country to another to sell in another country, so the deficit doesn't look as large. It's a blunt instrument. It was not reciprocity. Thailand, Vietnam, I don't know that they have any tariffs on us, but we're going to raise high tariffs because they provide a lot of goods to the U.S., but they don't buy any. And it makes a lot of sense because they don't have very developed countries or economies. So there's not a lot of the high capital cost goods that we sell to them, but they're looking at these very low cost, low profit margin, let's say textiles, and they send that to the U.S. It's like being upset that your grocery store doesn't buy as much from you as you buy from them. So that is, I think, one of the things that we're trying to understand, and the market's going to try to digest. And that's assuming that the formula that everyone's kind of backed out how they arrived at these numbers is an accurate one, and one that they're going to continue to look at. So I think the biggest thing is the uncertainty by this policy and how our economy is going to find equilibrium. What's the change? What happens if tariffs are reduced? Do the countries even have tariffs to reduce? It's an odd situation, but I do think it will cause things to move to the U.S. That would not have happened without this tariff. That doesn't mean it's a good thing, but that's the way that I'm seeing it.
Let's go to some of the good news. Some of the reports, and this actually could be its own 30-minute discussion, is the savings versus spending. We've seen new data come out, PCE, and I'm going to throw up a chart here, and it is the personal income and outlays. Blue line is disposable income and the change in growth, and the outlays, the spending, which is what really the mainstream economists like to follow, is just pure spending numbers. Those came in a little bit lower than expected when we look at the orange line, but the savings rate, the what is generally seen as a sign of uncertainty, people are saving, was strong. And in our models, when we take the more of the Austrian views, strong savings is actually a good sign for long-term growth. So we're seeing this increase in savings rates where we see the consumer does still look strong, and that really creates the ability to have some more of these long-term business investments by having that savings stock.
I would completely agree. A lot of times when people are talking about trade deficits, I've always been against tariffs and worrying about trade deficits. They forget about the capital surplus. So if these reciprocal tariffs, quote unquote reciprocal tariffs, are going to have an impact on trade deficit, and I think they could, then there's going to be a lack of capital surplus. But because of the uncertainty and the fear that's in the market, it's causing people to save more, so that is already starting to offset some of that. And interest rates are coming down. That can cause consumption to be reduced and investment to increase. So that could actually be a decent thing for the economy, because now instead of consuming, people are looking at investments and trying to increase production, which is actually what you would want to do in a situation like this. If you're having to produce things more at home, you want to increase your production capacity so you can do it more efficient. So I don't think that is a bad thing long term. I do think it's going to hit the standard of living for people. I do think Trump is going to be able to point at these things as the seen things. There is going to be manufacturing brought back. There are going to be investments in the U.S. as people try to work a way around that. You won't see all the unseen on what could have been. It's Bastide's broken window fallacy all over again. But the other thing that I see is everyone talking about the inflation increase on CPI, and I'll reference Milton Friedman. Inflation is always and everywhere a monetary phenomena. This is not monetary driven. So we will see prices of some things going on. It'll be very selective. Let's say cars go up, but that means there's less money in people's pockets to spend elsewhere on the goods here. So you could actually see the general price kind of be stable. I think there'll be some inflation, but it won't be a spike.
Let's break that down, because that's some of what could be the good news from pricing of what the market's looking at. If you just take general what is thought of at the market, the GDP expectations from these tariffs is probably a reduction of 1%, maybe 1.5% on the high side. Pretty big reduction in GDP is what would be expected from this. The inflation numbers getting thrown around is over 1.5%. And so we would look at that and say GDP is probably going to have that decline. I do think there will be a higher offset from some of the domestic investment you're talking about, but there's going to be a decline if these continue. And the price increases are, on our opinion, not going to be as high as what's expected from the rest of the market. So you do get some of that benefit of just when what the market is starting to price in is a little bit too much.
I agree, and it's the way, and I've critiqued the way that we measure inflation for a long time. There's all kinds of substitutions. It really doesn't capture it well, and I think this is another example. So let's take the car industry. All of a sudden, car prices go up, but now that you have less money, you can't spend it on consumer discretionary items, so those prices go down. They offset, but over time, you're going to get an equilibrium because cars are more expensive. People are going to keep them longer. They're going to pay for more maintenance. So instead of getting a car every 4 years, maybe it's 6 or 7. So the overall cost per year for your vehicle actually is about what it is. So then you'll start to see consumer discretionary actually pick up later on as they come to equilibrium. So CPI doesn't show any increase from that, but your standard of living does decrease because instead of having a new car every 4 years, you're at 6, 7, maybe 8 years. So your standard of living has gone down despite it really not showing up in the inflation rate. And it's a phenomena that is really tough to measure. But I think this is where Trump gets a political win likely here for being able to point to other things. He also probably doesn't lose in that inflation number unless the Fed comes out and really starts to lower interest rates. But I don't know they need to because we're seeing that natural reaction from people cutting their consumption to build up that uncertainty buffer on their cash.
Let's get to the portfolio impacts and risks of recession. So the chart I have here is recession risk from economists. They're usually incredibly wrong on the expectation. And you'll see right now, before this, we're right around 30% probability of recession in the next 12 months. Off of a higher base, somewhere around 20, I would probably disagree with that number. If you talk to people heading into the year, the recession risk for the year before a lot of this got ratcheted up was much lower than that, which is why I put in the title from 0 to 30, maybe a little higher than 30. So in recession, you see a drawdown in equities, a light recession, 25 to 30% drawdown. We're at 10. So when we look at the probabilities of what the market's predicting, it's probably somewhere around that 30% probability of recession. It seems to be a pretty reasonable place the market has taken. And when I look at that, I get to the point of saying, I don't think this leads to wanting to make any changes in your equities. You have equities, they're long-term investments. We've put them in a good spot for the long term. We will do some short-term trading in qualified accounts where taxes don't matter. But when I get to the portfolio impacts, I know our retirees have nearly 2 years of cash. They don't have to worry about selling while the market's down. I think the best way, because we will see strong recoveries when there is more clarity around these numbers, it's why you don't want to be making large changes in your equities, is we can look to fixed income where there are not large changes in pricing that happen over news like this. So when we look at our fixed income, we want to make sure they're hedging our equities. When we looked at a trade we made this week on one of our bond strategies is Jeffrey Gundlach, very famous bond manager who's when you manage bonds, you often call for recession more than equity managers. He's at 60% probability of recession. So he's positioning a portfolio for that outlook. I think that hedges really nicely with our equities. It's a reason we put that position on in our strategies. Our other bond strategies, probably we're not getting the signals yet to make that trade. It's something that we'll see in the coming days, maybe weeks, of saying we should add a little bit more defensive on our taxable side of our fixed income. But to me, when we look at this, I think it's hedge a little bit more in your bonds.
That all makes sense to me. We will get some, there is more certainty, though there are still a decent amount of questions after yesterday. But the markets, tariffs are a tax increase. And we constantly have administrations that do raise taxes, both Republican and Democrat. Revenue goes up because of changes, right? So the market, as long as it's reasonably free, and we have a reasonably free market, they figure out ways of getting around those inefficiencies created by taxes. They're going to figure this out. Sure, there's going to be probably some short-term volatility, possibly a little R recession. But what do you want to do whenever you have that? Well, the market's going to be on sale. As you pointed out, we have a significant amount of cash set aside for people that need that liquidity. We have equity. We're looking at fixed income. We can make those changes. And I want to pay attention to who are the winners out of this. I think you're going to see industry and materials and construction. And if we have to bring on low margin industry like textiles, you're going to see automation. So that's what I would expect to actually win out of these situations. It's still too early to be, hey, let's go make bets on those. But that's what I'm looking for, is there's going to be some winners here and there's going to be some losers. Let's make sure we're positioning our portfolio so that we capture more of the winners than the losers. And I think you can make the case that on where those are going to be.
Yeah, and a good distinction on that would be size of businesses. Large cap companies maybe are more exposed to global trade, and that's something that can be a headwind there. Well, small cap businesses may have less global exposure, but they're more exposed to the recession you talked about. So there is a hedge there between the two, which is once that recession risk starts going down and the tariff risk is lower in some of those small caps, those could become, and mid caps, could become attractive looking investments, especially as they underweight, just by their nature, underweight some of the technology companies that tend to be more large cap. So that could be another opportunity that we'll be looking at, as you said, in the coming weeks.
I know year to date, international has done well relative to the U.S. domestic market, but if I'm thinking mid to long term, the U.S. is a huge economy where you can trade across. It's better than the EU. It's a single monetary policy. It's essentially a free trade zone, and it has an enormous amount of resources, an enormous amount of human capital, third largest by population. I don't see why you would want to leave the U.S. For investments mid to long term.
Going to be a moving target. We're going to see how the markets start to react to these over the next week. We'll probably be back next week with another low budget, quick recording before we hit it back to the studio and actually have an edited video. But I think in the short term, we'll keep checking in, seeing how the market's doing, seeing any changes we're talking about making, and we'll check in with you then.